My name's James Barron. I'm here to talk to you about the public sector exit cap payment regulations. Hopefully we've got hopefully be able to go through this. I'm expecting to talk for about an hour today about the regulations, some of the various issues that they cover, and what practical issues you might find as an employer who's caught by these regulations. I will apologise as well. My sort of meeting room, as you can see, I have my meeting room facing this way, and my son has his meeting room facing this way. So that's why the Duplo and Buzz Lightyear, I can confirm, is not mine. It is my son's, unfortunately. But I won't be using it as a prop either at any stage during the talk today, because probably it's a bit dry of a subject, and I don't think there's anything really where I could get Buzz involved, unfortunately, about the restriction on the public sector exit payments. So let's talk a bit about the overview of what we're going to talk about today. I'm just going to talk a bit about the background of how these regulations came into force and what they do, what organisations are covered by the cap, what payments are included in the cap, relaxation of the cap, practical issues, finally record keeping, transparency and compliance. What I would suggest is if we have any questions, I can either answer them, or if people would prefer, what will happen is at the final slide, I'll have my contact details. And if you do have any questions, obviously you can ask me, or alternatively, my colleague Ruth Mullen is also on this webinar. And if any of you know Ruth and would like to speak to her, we're more than happy to answer any questions that you may have. If you want to sort of organise a virtual coffee or anything like that with us and discuss some of the issues around this, we're more than happy to do so. So let's talk a bit about the background first. So the regulations have been proposed since 2015, and you would hope, and they're designed to stop six-figure exit payments. Now, you would obviously, that's why you have this slightly odd figure of £95,000. It's I think it's purely a decision to stop the figures being £100,000 and therefore six figures. So that's why you've got the figure of £95,000. It had appeared dormant for some time, but consultation again was launched on it last year, and the regulation was finalised mid-October, and it came into force yesterday. You would hope, I would have liked to have said that having it come into force in 2015 meant that because these regulations have been doing the rounds for 5 years, that by the time they came into force, absolutely everything that was a question mark had been finalised, and there was nothing that we needed to worry about and any questions we'd have. But unfortunately, spoiler alert for later, that is absolutely not the case. So we're going to talk about some of those issues. And I think most of you will probably know what those issues are regarding pension strain in particular. So we'll come to those issues later. It is worth noting they are currently subject to judicial review proceedings by various of the trade unions. Not entirely certain that those that will be successful in those challenge, simply because if you look at the regulations, they do have quite a detailed equality impact assessments, and a lot of the way that you can get around the cap are to do with equality related issues that might have otherwise caused it to be overturned in judicial review. So obviously I can't comment on that too much, saying because you never know, but certainly I wouldn't count on these regulations being successfully judicially reviewed. So the restriction places a cap of $95,000 on certain exit payments. So that's generally what the cap's going to do. Like, on a nutshell, that's what it does. We're going to go to why that's a bit more complicated soon, but in a nutshell, that's what it does. One key thing to note here, and you'll understand why in one of the later slides, is the restriction is on the relevant authority to make the payment rather than the employee receiving the payment. And I think that's something that might become key later in one of the slides to explain some of the practical issues. As a general rule, the way to look at this is if you're not sure about what payments are covered, and obviously there is sort of a more comprehensive list, but it only relations where there's an extra cost to the authority in relation to the exit payments. So therefore, lump sum pension entitlements are not covered unless the employer pays a strain. So if the employee is entitled to a lump sum pension upon exit, that doesn't necessarily mean that it comes under exit cap payments, because if there's no cost to the employer, then it's not covered by the regulations. So that's the general rule. If you're not sure, if it's not costing you any additional money, it's probably not covered. So who's covered by the restrictions? Now, what I would say is there's a very comprehensive list set out in the Schedule of the Regulations. Schedule of the Regulations set out a very comprehensive list. And if you're not sure, have a look, at that list. What I would say is certainly it follows the definition given by the Office for National Statistics. And what I would say is, having a look at the attendee list today, the predominant groups who are covered are local authorities, and all types of schools as well are covered. So that's most of the people I think attending today are going to absolutely be covered by this. There are some inconsistencies. So colleges aren't included, major one that isn't included, but 16 to 19 academies are. So there is sort of this slight inconsistency with some that are included and some that aren't. And one thing that I flagged is it's unclear if an employee has a role which crosses employers how this will work. Now, the key one to me where this might be the case, the example I could think of is if you go back to colleges, a college could quite often be a sponsor of an academy chain. In those circumstances, what you'd have is you probably have the principal of the college also be the chief executive of the academy chain. In that situation, if the chief executive and the principal were to leave their posts and to leave both posts, you would then be in a situation where one employer would be covered by the cap and the other wouldn't, and it is not entirely certain how the crossover between those roles will work. There's nothing in the guidance yet, there's nothing in the regulations yet, and it might just be a case of, if we have those situations, we might need to consider them, or it might just be a case of keeping any payments separate and that's how it's done. But we'll see how that happens, and if the guidance changes, then that's obviously something we can do. I think obviously one thing I'd say as well is, we're going to come to this later, but in particular regarding pension strains, a lot of what we're talking about now is in flux. There's lots of uncertainties. So what I would propose is we might not be able to answer all questions today that you might have, because simply there's no guidance or the regulations aren't enforced yet. So if particularly the changes to the LGPS. So what I would suggest is, what we're probably going to do is do an update on this issue, and we will keep everyone updated. We will send out regular updates. And if you're not on our update list but would like to receive those updates about what happens about public sector exit caps, please let us know. And of course, that's something we can arrange. So what is covered in the restriction? So what payments are covered by the restriction? So redundancy payments, firstly, that's probably the most obvious one. Pension strains, which is the one that causes most difficulties for everyone. Payments under a settlement agreement, so you can't just settle out of this. The settlement agreement would, any payment you make under a settlement agreement is going to be covered. Payments under an ACAS arbitration scheme or conciliation scheme. So if someone starts a tribunal claim and you settle it via ACAS, that is also an issue. I guess the reason behind this is to stop people finding a fudge way around it. Certainly, if you had a settlement, if you couldn't agree a settlement agreement and you asked the employee instead to start tribunal proceedings and you'd make a payment under ACAS, that obviously is going to frustrate the whole purpose of the policy. So I think that's why they've put that in there, to try and stop people getting around it. Shouldn't be too much of an issue for most employers that are covered, but payments in form of share options. I can't imagine many local authority schools or anyone else covered by the regulations are going to have share options they cannot offer people, but that absolutely, that is something that obviously is included in the cap. Voluntary exit payments. So this is probably in most circumstances a voluntary redundancy scheme. A payment to extinguish liability to pay money under a fixed term contract. That is also covered in the regulations. That also is included. So if someone has a long-term fixed term contract, if they say have a 12-month fixed term contract and you want to have to pay off the next 9 months of it, that payment would be included. And generally any other payment in consequence of a termination or loss of office. So basically that's a bit of a catch-all. If they're not included in anything, we've got that. So what isn't covered by the restriction? So death in service payments are not covered. That's a key one. Payment in respect of incapacity as a result of accident, injury or illness. Now, I think this covers two issues. The guidance doesn't make this clear, but I think this covers two issues. I think firstly, it relates to any personal injury claims. So if you have a member of staff who brings a personal injury claim, I don't think that would necessarily stop. But I also think this probably covers ill health retirements as well. It's not explicitly clear in the regulations or in the guidance what happens with ill health retirement. But I think from looking at those regulations and the way they're worded, particularly with the word of illness, my guess would be it probably does cover ill health retirement, but that's something we'll need to keep an eye on and probably clarify at a later date once we have a bit more clarity. Annual leave not taken under their contract, so any annual leave that the employee has can be taken. Payments in compliance with an order of a court or tribunal. So basically, if you lose a case, a tribunal, and the tribunal orders you to make a payment, and that would take you over the cap, you can make that payment. Now, there are some ways which you can sort of obviously relax the cap, which we're going to come to later. But what you'll find is, if we go back to the last slide, if I just show you, because you can't make a payment under ACAS arbitration scheme or conciliation agreements, but you can make a payment in compliance with an order of a court or tribunal, there may be some weird, odd, isolated circumstances where an employee brings a claim against you, you know you will lose, but you can't pay because it's going to take you over the cap, where effectively you would probably have to go to tribunal to lose that claim to be able to make the payment. It seems a bit odd to me. It should be very rare because of the exclusions that are included in the cap, and that's something we're going to come to later. But just keep it in mind, it is a bit of an odd one, and hopefully that will be something that's going to be rectified in the future. And a payment in lieu of notice is included, but this is a big but. It cannot exceed a quarter of their salary, so i.e. 3 months. So any notice period that's over 3 months will be included in the cap. So the way to look at this is you need to split the payments. If you have a member of staff who has, say, a 12-month notice period, the first 3 months wouldn't be covered by the cap, but the additional 9 months of that notice period would. So that's the way to look at it. Anything over 3 months will be covered in the cap. 3 months isn't included, but anything over 3 months is included. So that's something to keep in mind. Statutory redundancy payments. It's also not covered this restriction, but it's treated slightly differently. So employees will still retain their entitlement to a statutory redundancy payment. That's the sort of a key thing to keep in mind. They would still retain that entitlement, and that's something they will still be entitled to. However, the statutory redundancy payment takes them over the restriction cap, then another payment must be reduced to bring the total payment down to 95,000. So the way to look at this is it's treated slightly differently. The other payments we've talked about in the last slide were not included in the cap at all. So you can make those payments and not include them in the cap. The statutory redundancy payment needs to be included no matter what, but you then need to reduce other payments to bring it under the cap. So it's technically not included, but it forms part of the cap, so it probably is. So it's something to just keep in mind. Hopefully it shouldn't be too much of an issue, because if I'm being honest, most of the time, if you're going to be hitting the cap, most of the time you'd assume the employee is going to be getting more than the statutory redundancy payment, but it is something to keep in mind. It is treated slightly differently, so it's worth keeping that in mind. So if we go to the next slide, I'd also say as well, going through these slides as well, actually sort of at the pace we're going through them, I know we're in for an hour today, but I expect us to be 30 or 40 minutes. So we should be done not long after 10 o'clock. So hopefully, I know sort of, particularly with the people I'm speaking to, everyone's going to be very busy at the minute. So hopefully I won't be keeping you too long. And obviously we will have a copy of this slides, and I think we are recording this as well. So if there are any colleagues who you think this might be useful for, we can of course send a recording to them and a copy of the slides as well. So just to make that clear. So the relaxation of the cap. There are times in which you can relax the cap, and we're going to come to those in the next few slides. But what we need to be careful of is what's the procedure for that. So for local authorities, any relaxation of the cap must be made by the full council of that local authority. So the way it works is under the regulations, technically it's HM Treasury and the Treasury Minister have the authority to relax the cap, but they can delegate that authority to certain people. Now that authority is delegated to various devolved authorities, the Welsh authorities, etc. But because of the people who are attending this, I'm not really going into any detail about this. And there are some other things that we're not going to go into detail about. Because there's no one here from the Nuclear Decommissioning Agency, I've not gone into the various complicated pension issues that relate to the Nuclear Decommissioning Agency, which is very complex, but luckily nothing we need to worry about here. But for local authorities, the authority to relax that cap is delegated to you. So you wouldn't necessarily need to go to central government to get that cap relaxed. It would need to be a full council decision to make that. So it wouldn't be any subcommittees. It needs to be a full council decision, any decision to relax the cap. For others, it will be the relevant sponsoring department. So, for instance, in the academy sector, it would be the ESFA who would be having to make that payment. So that's something to keep in mind as well. I think in those circumstances, I think what you probably find is, particularly for academies, what you'd probably find is realistically, if you're going over the cap anyway, you're probably making a payment of over £50,000, in which case you need ESFA approval in any event. So it's probably just going to be tied into that. So for some bodies, it wouldn't be that different to what you're having to do now in terms of getting approval for large payments anyway. You need to submit a business case to the relevant department about why you're wanting to sort of relax the cap. And although that is for the relevant department, I would also say for local authorities as well, when it's full council decision, I would probably follow the same procedure and make clear there's a clear business case on why it needs to be followed, just so you've got that audit trail. But HM Treasury has set out a list of occasions when the cap must be relaxed and when it is discretionary. So let's talk a bit first about when the cap must be relaxed. So these are mandatory occasions on which it must be relaxed. So first one is if an obligation arises due to a TUPE transfer. So what we're saying about this cap is if someone transfers to you and they're entitled to a payment that exceeds the £95,000 cap, you are allowed to breach that cap if because of the reason for that payment is due to a TUPE transfer, so because they've transferred on those terms and conditions. Now, what I'm not entirely certain of at this stage is what are the circumstances if that member of staff was previously employed by an employer who was subject to the cap. Because in those circumstances, there probably should have been a change. So if someone transfers from one local authority to another local authority or one public sector organisation under a TUPE transfer, what's the situation here? Thinking it through, probably the most likely sort of scenario in this case is what happens if it's a local authority school and transfers to academy status. Both of those employers are covered by the £95,000 cap, and all of a sudden is the £95,000 cap removed because there's been a TUPE transfer. The answer to that is that it's not clear. I would say probably not, but again, we'll probably need further guidance on this point, and hopefully that will become clear in the future. Now, the other occasions, and we're going to go through all of these, I'll go through all of these as one because they're all very similar. So the other mandatory occasions are when there's been to settle agreements for employment tribunal involving a whistleblowing complaint, to settle agreements for employment tribunal claim involving detriment or dismissal due to health and safety related activities, and to settle agreements for employment tribunal claim involving a discrimination complaint. Now, you might be aware that the three things that link those three different types of claims are all claims which lift the statutory cap at the employment tribunal. So the statutory cap at the employment tribunal, compensation is limited to the lesser of 1 year's salary or a payment, I think it's around £78,000 currently. So all those types of claims would lift that cap. So potentially you could easily have a situation where an employee is entitled to more than the statutory cap. And in those circumstances, you can, and according to the guidance, you must relax the cap in those circumstances. Now, obviously, there are some rules around this, and there's some things that's worth keeping in mind. So we'll just talk about those now. Firstly, the first thing to keep in mind is it's a grievance or an employment tribunal claim. So you're not required to make sure that the employee actually brings an employment tribunal claim before you settle it. If you feel that a member of staff has a really good claim, you can settle it as a settlement agreement, because if they raise a grievance, then you can deal with it in those circumstances. So there are ways in which it can be done. So that's the first thing to keep in mind at what stage it can be done. Other thing to keep in mind is you need to have taken legal advice, and you need to be of the reasonable opinion that you will probably lose the claim. That's what it makes clear. So you probably need to get advice. It's not clear whether that advice needs to be independent legal advice outside of the council, or whether it can be internal legal advice. But you're going to need advice that there are risks that are worth settling the case, and therefore worth that you need to relax the cap. Now, it just make it clear as well, these are mandatory occasions. So if you do have that view that you need to relax the cap, if that's what's required to make a payment to settle the claim. So that's something to keep in mind. Now, if we just go to discretionary occasions, because these occasions when you can. So these occasions when you can choose to relax the cap. Now, the first one is compassionate grounds owing to genuine hardship. Now, this is put in there, again, I think if I'm being honest, this is put in there to sort of try and protect from any judicial review proceedings, because realistically, if you think about this, if an employee is receiving a payment of around £95,000, however, in whatever way that's coming to them, it's going to be very hard for them to say they're going to suffer in genuine hardship. So it's in there, but I can't imagine many situations where an employee would actually be able to show there's been genuine hardship. There might be some occasions, and obviously you can judge them on a case-by-case basis, but that is the case. You can also do it to give effect to urgent workplace reforms. So you might find a situation where you want to make urgent workplace reforms, things need to change, but because the cap's in place, you can't make those changes. You need to move certain people on, but you can't move those people on because of the cap. In those circumstances, if you can make a sufficient business case, you can say, we can relax the cap because we need to make these urgent workplace reforms. These workplace reforms are so urgent, they need to take place, and the only way to do that is by relaxing the cap, so we need to do that. This is an interesting one because it's not quite as wide as some people might think. It's an agreement to exit was in place and was due to take into effect before the regulations came into place, and there's a reasonable reason to show why that delay took place. One of the questions that quite often got asked between these regulations coming into force, because they were taking place, coming into force relatively quickly after the regulations were introduced, was about what do we do about things that have already been agreed. So obviously it can be quite clear. Sometimes you might want a sort of a long period of time where there's a handover period. You might have agreed a settlement agreement with an employee in September, October, but they might be leaving to March next year. Now, the problem is with the regulations is those agreements are still covered by the cap, even if you agreed it beforehand. It's only if there was a situation where it was agreed beforehand and it was due to come into effect before yesterday that the regulations are sort of discounted. So let's say if you had a situation where you might have an employee who is, maybe there was something urgent going on, and so you needed to delay their end date due to sort of them working on urgent coronavirus type issues, then you would be able to say, yes, we agreed it beforehand, it was only delayed due to a reasonable reason. So it's actually a relatively narrow reason, and obviously it's going to be something that might be relevant for the next 3 to 6 months, but after that is not something that's realistically going to be used. And finally, there is a mechanism for a discretionary waiver by submission of a business case to the relevant sponsoring authority. So there is a potential discretionary waiver that you can do. So if it doesn't come under any of these circumstances, there might be other circumstances where you can apply for this discretionary waiver to discount the cap. What those circumstances might be aren't clear in the guidance, because I think it's just going to be on a case-by-case basis. It's also not immediately clear because it says it has to be to the relevant sponsoring authority department. It's not immediately clear on first reading what would be the case for local authorities. I still think they would have to delegate to the authority to make the decision themselves, but the problem is without guidance about when that discretionary waiver might be used, it might be difficult to come to that decision. So it's something that needs to be kept in mind, really. Now, let's go on to the practical issues, which is where some of the problems come back. So far, everything is relatively straightforward. These are the regulations, and it's relatively straightforward. What we're going to come on to now is some of the practical issues that are going to be caused by these regulations that you guys as a local authority and a school and all sorts of public sector employers are going to need to think about. So, the regulations or the guidance give no indication which the priority of the payment should be made. Now, on the face of it, this seems like a good thing. What they're saying is we want people to have the autonomy to make payments in the way they think they should make them. So we're not going to say you should make this payment, this payment, this payment. But this causes quite significant issues because there's no preference to the payments. Now, we're going to talk about pensions in a second, but the other one that could be quite clearly an issue here is what do you do about payments in lieu of notice? A payment in lieu of notice obviously is going to attract a tax payment. If a member of staff has a long payment in lieu of notice over 3 months, that's going to attract a tax payment, and obviously that's going to be counted toward the exit cap. Now, what you're probably going to have in those circumstances, if this employee is also entitled to a large redundancy payments, you're probably going to have employees, trade unions, and maybe solicitors acting for employees saying, well, you need to be doing the redundancy payment first. So like any payment in lieu of notice liability is going to be reduced. I would say that's absolutely not the right way of doing things, but the guidance doesn't make it clear. I would say the first thing you should be doing is any contractual payments first. So any payment in lieu of notice, etc., should be done first, then any redundancy payment, and move on from those circumstances. But the guidance doesn't make that clear. So I can see having arguments, and this is something we're going to come on to in the future, but it might be worth having having documents, having policies in place to deal with this, and that's something we're going to talk about shortly. But I think this is probably the biggest question that most people have, is the biggest problem this may cause is the tension between contractual obligations to an employee and the potential for an employee to receive an immediate unreduced pension. So let's go on to the next slide to talk about this. So the idea is here that obviously an employee, if you under their current sort of contractual rights, if they have entitled to a large redundancy payment, are entitled to that redundancy payment on a contractual basis. But they're also entitled to, if they're over 55, and they're part of the local government pension scheme, they're also entitled to have a non-actuarially reduced pension if they're dismissed for redundancy reasons in those circumstances. Now, the problem you have in these circumstances, because those two rights still exist, no matter what happens in these caps, those rights still exist, and that can easily take you over the cap. So we need to think about how we're going to do that. Now, Regulation 8 gives you an option. It means that an employer, as an alternative, if they're unable to pay the pension strain, can offer the employee a cash alternative up to the level of the cap. So as an example, let's say if all alternative payments had been, say, £60,000, and so they had £35,000 left, but the pension strain was, say, another £60,000, then as an alternative, they can make a £35,000 cash payment to the employee. And that's what the government have been suggested to do. However, this carries quite significant risks, and I'm sure a lot of you will have seen the guidance from the local government pension scheme and the legal advice they've taken, and they're concerned about this. What they've said is they're worried that this could be challenged, and you could end up in a situation where you're having to pay out twice. You could end up in a situation where you're paying out this cash sum, but the employee successfully challenges the decision not to pay out the unreduced actuarial pension, in which case you're going to be end up paying out to the employer twice. So it's not an ideal situation at all. And the problem with this is, if I'm being completely honest, this is a situation which was very easily avoided, because there are amendments that are coming to the LGPS regulations which will deal with this issue. The consultation for those actually end tomorrow. So we're in this sort of weird middle day between the regulations coming into force and the consultation for the LGPS regulations finishing tomorrow. They're expected to come into force, if not late this year, early next year, and that will hopefully resolve most of the issues. However, we are now currently in this limbo period where we don't know what to do. We don't know what to do. There's a risk attached to anything. Now, what I would say is, if you do find yourself in this situation, it's probably worth looking at the individual circumstances, probably worth getting specific advice about these particular circumstances. But if it's possible, and this isn't normally something I advocate, I'm normally one about not kicking a can down the road and dealing with problems as they arise. But if possible, I think this is a circumstance where legitimately, if you can avoid making anyone redundant or making any exit payments where you think you may fall into this issue, if you can delay them till early next year, delay them till early next year. Early next year, the LGPS regulations will be in force and everything will be much clearer. Also, additionally, if there's been any challenges to the current environment, someone else would have been through that case, and we hopefully will have had a precedent to know what the position is. I always say to people, you don't want to be a test case to see what the law is. The only people who are happy with that are lawyers. So I don't know if Jonathan and Ruth will be happy with me telling you not to do that, but that's the only people who sort of be happy with those situations are lawyers. So my advice would be, if you can wait, please do wait. I know it's sort of like complicated, it's complex, but I would suggest waiting in these circumstances if you can. Now, other practical issues. The cap only employs to the employer and not to the employee. And so therefore, if the employee cheaply transfers out, the cap no longer applies potentially. Now, there is an issue here if they go to another public sector employer, but if they're not going to a public sector employer, then the cap will no longer apply to them if their contractual position still entitles them to these very high redundancy payments. Now, the reason this might be significant is, I guess there's a probably hope in some senses where there might be a case of, can we reduce our outsourcing costs? If there are people being cheaply transferred out of the local authority, are we going to be able to reduce costs in those senses, and sort of like there are going to be less issues because the cap's going to apply, and therefore the risks to any new employer of those people are going to be lessened. Unfortunately, that's not the case because it only applies to you as the employer. So that's something that you need to keep in mind. But the other thing to keep in mind is that it doesn't actually extinguish employers' legal and contractual liabilities. This is one of the odd things about this public sector exit cap, and it's something we talked a bit about earlier when we were talking about employment tribunal claims. You can end up easily in a situation where an employee still has a legal right to bring a claim. So just because this cap exists doesn't mean an employee is not still entitled to anything they're legally entitled to. So any contractual payments that took them over £95,000, they're still legally entitled to, even though the cap restricts you on making that payment. So therefore, what you'll need to do as an employer realistically is you're probably going to need to amend your policies, which isn't going to be popular at all, but it needs to be done, because otherwise you could have a situation where you're making large payments to members of staff, but if there's any sort of shortfall on what those payments are, you're then going to be in a position where they legally could take you to an employment tribunal and bring a breach of contract claim, or could take you to a court and bring a breach of contract claim. So it could end up in quite a few difficulties for you. So that's why you might want to consider changing your policies. I know it might be hard, it might be a bit of a headache, and I certainly don't think the unions are going to be particularly happy about it, but I think it's something that you're going to have to do in the long run. And I think if you do that at the same time, you obviously can make a few decisions about what you're going to do in terms of order of preference. You can make it clear, for instance, payment in lieu of notice will be the first payment made and stuff like that. Because there's nothing that sets out in the regulations about how that's done, and it gives you the freedom to do so, it also means you have the freedom to specify what payment should go first under a policy. And that's certainly something I would be advising if you were looking at a specific policy. And just finally, from a practical issue as well, if two or more payments within a 28-day period from public sector employers, the payments together must not exceed the cap. The most obvious example I can think of is if you have a senior member of staff doing a job share between two organisations. If that member of staff is made redundant from both of those organisations, you take the number, but both organisations are paying against the cap. It's not a case of one person can pay 95,000, the other can pay 95,000. That's not the case. It needs to be the two together. However, it's more than 28 days together. If there's a greater sort of period than 28 days, then that obviously isn't the case, and they can make those payments. So we're coming to the final few slides now. Like I said, it's kind of a whistle-stop tour. Hopefully there'll be some more information later as it becomes available, but hopefully I shouldn't keep you too much longer, possibly another 5 minutes. So we're finally just going to talk about record keeping, transparency, and compliance. So you need to keep records for 3 years for occasions where the restriction has been relaxed. So you don't necessarily need to keep keep records of where you've hit the cap or anything like that. The regulations only require you to keep records where you've decided to relax the cap. Now, you'll need to detail the name of the employee that was paid, which is potentially quite contentious, to be honest, the amount and type of exit payments which were relaxed, the date the cap was relaxed, and the reason why the cap was relaxed. So probably sort of the information that you would expect to be keeping, and that needs to be kept for 3 years. But also in terms of transparency, you're expected to publish those decisions to relax the cap, and this should be in your annual accounts. Now, obviously, this could cause quite a few difficulties for the simple fact that you need to detail the name of the employee that was paid. Obviously, that's going to cause some difficulties, and that's something we're going to have to sort of have a think about in the future. That's something we're going to have to think about in the future. So that's something to keep in mind. Oops, sorry. And also we're going to finally talk about compliance, the final slide beforehand. So if a payment is made and the rules to follow the relaxation are not properly relaxed, this may result in sanctions if appropriate. And what appropriate means, we don't know. What sanctions mean, we don't know. I think it's more obvious in academies. I think if you're an academy and you make a payment over this, I think you're probably going to get the ESFA knocking on your door for local authorities and other organisations, it's not quite as clear what those sanctions might be, but just be aware there is the opportunity for sanctions. And additionally, this is the final thing to keep in mind. If you do make a payment over the cap, whether that's because you've not properly relaxed it, or wasn't relaxed in the proper way, or you made a mistake, which is probably an easy thing that can be done in these circumstances, you'll need to make a value for money assessment on whether they should pursue civil repayment through the courts. So that's something that you need to do in those circumstances. If you've paid over the cap, the regulations and the guidance make clear that you should be trying to reclaim that money from that member of staff over that cap. And so that's something else to keep in mind. So that's it. That's a sort of whistle-stop tour. I hope you found that helpful. Obviously, there's quite a few things that you're probably going to need to think about after today. It's one of those where the regulations aren't that big, the guidance isn't that big, and so obviously the seminar today isn't too long, but there's a lot of things to think about. And certainly at Forbes, if there is anything that we can help with, we'd be more than happy to do so. If you need assistance sort of with drafting these policies, if you have any cases that you think might take you over the cap that you want independent advice on, that's something we could do for you, and we'd absolutely be more than happy to help. But what I would say is, if you do have any questions about today, and like I said, I think there's more to be told. I think there's more that we're going to find out that we don't yet know. And I think if that is the case, what I would say is we're going to put out some more information, and we'll put more information out as and when it becomes available. But in the meantime, my contact details are below. Obviously, if you want to contact me, please feel free to do so. I know some of you will know my colleague, Ruth Mullen. If you want to contact Ruth as well, she'd be more than happy to talk to you. So if any of you want to speak to us about anything you've heard today, we'd be more than happy to discuss. So what I would say is, before we log off, we've gone through that quite quickly, and so we're just after 10 o'clock now. If anyone does have any questions, the Q&A is open. I'm more than happy to answer any questions that anyone has if we can answer them. Or alternatively, like I said, if you want to contact myself or my colleague Ruth, we'd be more than happy to have a conversation with you about anything that's come out of today. So I'll just give it a couple of minutes, and if any questions do arise, we can of course deal with those. Let's see. I think one question I've just been asked is about what are the key risks for you guys as employers? And I think what I would say to you guys is, you're in kind of a difficult position, because like I said, the problem with this cap is that it doesn't change the legal position. So it changes what payments you can make, but it doesn't change the legal position. So you could easily find yourself in a situation where an employee is legally entitled to payments, but you cannot make those payments, which is obviously a really, really difficult position to be in. So I would say the key thing for employers to keep in mind is, I think, if I'm being honest, this is something that you're probably not going to have to worry about in 2.5 years' time, because in 2.5 years' time, hopefully you'll have changed all your policies. Everything you'll be certain about what you're having to do, and things at that stage should be relatively straightforward. I say this sort of like fingers crossed, who knows what's going to happen, but I would presume within a couple of years, things should be slightly different, and you should be able to sort of make those changes. The key issue you have is in the interim period. So it's in this period where employees are probably still legally entitled to these redundancy payments, to these pension strains, but you're not legally allowed to make them. So that's why I would say the LGPS regulations need to come into force, because that's going to make a key difference. But the other key thing as well is to think about your policies and to make those changes as soon as you can, because the sooner you make those changes, the sooner that things will be more relatively straightforward for you. I think we've got another couple of questions. So. Let me just, one question is, what I've been asked is, does it matter when the payments are actually made? What if the redundancy and pension strains are made on different dates, or the pension strain is paid in installments over a period of time? Now, the question I'd have over this is, I would say it's arguably, I think potentially you might get away, if it's more than 28 days apart, then might be okay. But again, what I'd have to do is I'd have to check the exact regulation. So what I can do is the person who's asked that question, I'm happy to come back to you directly. If you drop me an email, I'm happy to go back to you directly just to double check the position on that one. I've also been asked to say, can courts approve a settlement by a Tomlin order? Is that a way around it? Potentially, yes, if it's brought in the civil claim. It's an interesting one. The way the regulations have been provided looks at settlement agreement, looks at it in the employment tribunal context, which is interesting because most of the claims that I would foresee being brought under this would be a breach of contract claim, which would be better brought in the civil courts rather than an employment tribunal, because employment tribunal has a limit. So you are right, like I would assume a Tomlin order might be the way around it. If you're in a civil court, the problem is if an employee brings it through an employment tribunal, there's no way around it, which is an interesting way. So hopefully it'll mostly be in a civil court that you're going to be suffering, that you can deal with those types of issues. But in an employment tribunal, you're going to be sort of facing some difficulties. Just give me a sec. So one of the questions I've just been asked is what can be done now? So, and I think the key thing about what you can do now is you need to be looking at amending your policies, I think is the first thing. I think that's sort of one of the first things. And I think what you need to be doing is you need to be getting your procedures and policies in place to be dealing with this. You might need to be considering about enforcement if you do have situations where people go over the cap. And obviously, if you do have that, as something we could sort of obviously assist with. But also make clear what these procedures are, get those procedures in place and make people aware, particularly if you're in local authority councillors. So if you do go to full council to relax these decisions, councils know what they need to do. If you just give me a second, I'll just read the next questions that have come through. So one question is, when will we know about proposed changes to the discretionary payment regs and how much you can pay in contractual redundancy payments? Again, I'm not entirely certain of that question at this stage. And again, it's something that hopefully will become clearer at a later date. What I would suspect is what it feels like to me is these regulations have come out relatively quickly, and there's and sort of like other regulations that need to be amended to take into account haven't caught up with it. So I would certainly expect that to be done by the early part of next year. But again, that's far from certain, so we'll see what happens. And let me just have a look at this final question. Sorry, I'm just reading this final question and just having to think about it. So what obligations might an employer have to consider a waiver? Could an employee sue if not done? It's what I would say is if it's in the mandatory category, you would probably, yes, have to consider like a relaxation of the cap in those circumstances because it's mandatory in those circumstances. If it's discretionary, I guess there could be a legal challenge to it, but I guess what I would say is what would that legal challenge be? As it's you discretion, exercising a discretionary authority, my guess would be the only way of challenging that would be judicial review, which obviously is going to be very time consuming and expensive for an employer and might not be worthwhile depending on the figures involved. So what I would say is if it's a mandatory one, they absolutely could challenge that, and it's discretionary, they could challenge that, but obviously both decisions would probably be by judicial review, and so it might be quite difficult and time consuming for them to challenge those decisions. So it is something that's worth thinking about, but obviously it's going to be quite difficult for them. But I think those are all the questions we've had in today. Like I've said, I think there are a few sort of like key issues that sort of aren't immediately clear yet. And obviously if we can answer those questions, hopefully things will become to light at a later date. One question is actually asked, how long will the waiver process take realistically? I guess what I would say is, from your guys' perspective, it depends on whether you're a local authority or an academy. Probably the best way of thinking about it. If you're a local authority, the decision to relax the cap is done by your full council. So realistically, it's within your own hands about how you can relax that cap and how quickly that can be done. It's almost in your own hands about how you do that. You probably want to make sure it's suitably robust so you can deal with any challenges to that, but certainly that could be done relatively quickly because it's within your own hands. I think the bigger difficulty is for if you have a sponsoring authority such as academies with the ESFA and you're relying on third parties to make that decision, how long might that take? Now, certainly from my experience of dealing with the ESFA, those decisions can take 3-4 weeks normally at times, it's certainly in my experience. So that's the sort of period of time which you're looking at. So it's not a quick process, but hopefully for local authorities, it should be slightly easier because it's in your own hands. Although I'm saying that I know getting a full council decision together to make a decision is not going to be the easiest thing in the world. So that might not be the case. But yeah, I'm hoping that's been really useful for everyone. Like I said, obviously, I appreciate there are still lots of questions left to be answered. And like I said, we will be keeping everyone updated. And if you aren't part of our database but want to be updated specifically about these questions, that's something absolutely we can do. One question actually does it have to be a unanimous decision for the full council? My guess would be no, because the guidance says it has to be a decision taken by the full council. So my guess would be that means it needs to be a majority decision rather than unanimous, but we can just check, I can double check the guidance on that. I'm pretty sure it's just a decision that's delegated. So it doesn't need to be a unanimous decision would be my view. If you can get unanimous approval, all the better, but I think it would just be a majority decision as long as the full council was quorate would be my assumption looking at the guidance, but obviously we can confirm that at a later date if necessary. But I just wanted to say thank you everyone for attending. Obviously my details, hopefully you managed to get down my details. And if you do have any questions that you want to sort of take offline with me and have a conversation, more than happy to do so. But I wanted to say thank you for everyone attending today. I hope you found it useful. Like I said, we will be sending out the slides, and we have also done a recording of this event. So if anyone feels like this may be useful for some colleagues and they want to send that to some colleagues, obviously we can do so. But hopefully, I'm sure we'll be in touch soon once we know greater clarity around some of the issues that hopefully are coming into force and once we know more. So thank you for attending today. Good morning, and hope you have a good rest of the day. Thank you, everyone.